$1,060,000. That's the average American household's net worth. $192,700. That's the median. Both numbers come from the same Federal Reserve survey. Both are correct. And the gap between them is the reason almost everybody who opens their own banking app feels behind. The average gets dragged upward by a small number of enormous fortunes. The median is the household standing in the actual middle, half of America above, half below. When you compare your life to the average, you're comparing yourself to a number almost nobody lives at. So here's the real ladder. 11 rungs, from 0 to the top 1%. Every one of them a number the Federal Reserve actually measured. What each rung feels like, what breaks at each one, and the specific thing that moves you up to the next. Start at the bottom, and the bottom is lower than most people think. Roughly 1 household in 10 in America has a net worth of 0 or less. Not low, negative. Everything they own minus everything they owe comes out under nothing. At this rung, the number in your account isn't a balance, it's a countdown. $412 in checking, rent is $1,100, and it's the 19th. You know your account number by heart. You check the app before you buy coffee, and you check it again an hour later, like the number might have changed its mind. $27,000 in student loans, $3,800 on a card at 24.99%. A car worth $9,000 with $11,000 still owed on it, which is its own quiet arithmetic. You own negative $2,000 of car. Nothing here is reckless. That's the part people get wrong about the bottom rung. No gambling, no shopping problem. Just a series of completely reasonable decisions made by somebody who never had a single month of margin to make a better one. And the cruelty of this rung is that it costs the most to stand on. A $35 overdraft fee 3 times in a year is $105 charged to the person with the least. Tires bought 1 at a time instead of 4. A security deposit you can't put down, so you rent the worst thing at the higher rate, forever. Being broke has a price, and the price is a percentage of almost nothing. On $3,800 at 24.99%, you're paying about $79 a month in interest alone. $950 a year, buying nothing. Not principal, not progress. Rent on a mistake you made when you had no other option. Added up for 1 year at this rung. $950 in card interest, $105 in overdraft fees, maybe $200 more in the markup you pay for buying things 1 at a time instead of all at once. $1,250, gone, for the crime of not already having money. There's exactly one thing that moves you off this rung. It isn't a raise. $27,016. 1 in 4 American households is below this line. The thing that moved you here wasn't income. It was that card hitting 0. That's the whole move. $3,800 of high-interest debt, gone. Your salary didn't change by $1. Your net worth went up by $3,800 the day the balance cleared. And it keeps going up every month after, because the $79 that was buying nothing is now buying something. That's the first rule of this ladder, and it holds all the way to the middle. Below the median, your net worth moves because of what you stop paying, not because of what you start earning. You feel it as quiet, not as wealth. The app opens without your stomach dropping. Tires get bought in pairs. A tow truck on a Thursday is a bad day instead of a catastrophe that takes 2 months to absorb. And that $79 a month has to go somewhere now. Put it into an index fund and leave it alone for 20 years at an 8% average return, and it becomes roughly $46,000. The same $79. The only thing that changed is which direction it was pointed. And there's a specific moment on this rung almost nobody warns you about. You get a raise, $6,000 a year, which lands as about $387 a month after tax. And within 90 days, you cannot find it.
It's gone. Absorbed. Your balance looks the same in March as it did in December. That's not a discipline failure. Your sense of what's normal recalibrates in about a month, and it recalibrates upward every time. A slightly better grocery run, a subscription you don't cancel, delivery on a Tuesday because it was a long day. None of it is a decision you'd defend, because none of it was a decision. Which means the thing standing between this rung and the next one isn't earning more. It's making sure the money never reaches the account it can disappear from. $39,000. Median net worth for an American household under 35. Sit with that against rung 2. The typical household under 35 is about $12,000 above the 25th percentile of the entire country. Being young and doing fine still puts you within reach of the bottom quarter of everybody. That's not a personal failure. That's what the starting line actually looks like. Here's what changed to get you here. You automated it. $400 a month, leaving the account the day after payday, before you can have an opinion about it. Not budgeted, not decided each month, moved by a rule you set once, on a Tuesday, and then stopped thinking about. $4,800 a year that never had a chance to become dinner. That's the answer to the disappearing raise. The money you never see is the money you keep. Every household that climbs this ladder runs some version of this, and almost every household that stalls runs the opposite. They save whatever's left at the end of the month, and there is never anything left at the end of the month. But your money is still just sitting there. $39,000 in a standard savings account at 0.01% earns $3.90 for the year. The same $39,000 in a high-yield account at 4.15% earns about $1,619, with the same federal insurance behind it for filling out one form. $1,619 against $3.90. Same money, same safety. Nobody at the bank is going to call and tell you. Stretch that further. $39,000 left in index funds for 10 years at a 7% average return is about $76,700, without you adding a single dollar. The same $39,000 in that standard savings account after 10 years is $39,039, which points at the thing that separates this rung from the next, and it isn't how much you save. It's where you put it and how long you're willing to leave it there. $135,600. Median household net worth, ages 35 to 44. Between Rung 3 and Rung 4, the typical household adds about $96,000. That's roughly a decade, and most of it isn't saved out of a paycheck, it's grown, and it's built up in a house. This is the rung where your money takes a second job. There's a 401k with an employer match. 4% on a $70,000 salary is $2,800 a year you did nothing to earn. Turning that down to stay current on a credit card is the most expensive trade available to a working household, and an enormous number of people make it. There are index funds now instead of a savings account. Something you own goes up while you sleep, and some years it goes down, and you have learned, usually the hard way, usually in one bad spring, not to touch it either way. And somewhere in here you cross a number that changes the physics of the whole thing. When your invested balance gets big enough, its growth in a single year exceeds everything you personally put in that year. At $100,000 invested at an 8% average return, that's $8,000 of growth against $6,000 of contributions. Your money starts outworking you, quietly, on a Tuesday, with no announcement and nobody to tell. Worth knowing what this rung is actually made of, though. For most households here, well over half of that $135,000 is equity in a house they live in, and a large share of the rest is locked inside a retirement account they can't reach for 20 years without a penalty.
The number is real. Very little of it is available. Here's what nobody warns you about this rung, though. It's where the largest number of households quietly stop climbing, and the reason has nothing to do with the market. $192,700. Half of America is above this, half is below. This is the rung the whole ladder is really about, because it's the one nobody believes they're standing on. Ask a household sitting exactly here how they're doing, and they'll tell you they're behind. They aren't behind. They're the precise middle of the United States. Here's why it doesn't feel like it. Most of this number isn't money. For the typical household at this level, the largest single piece is home equity, value that's real and countable and completely unavailable at 4 o'clock on a Wednesday when the furnace dies. You can be at the exact median net worth of the country and still not have $1,800 for a furnace. Run the split. Say $120,000 of it is home equity and $55,000 is in retirement accounts. That leaves something like $17,000 you could actually reach this week, and a chunk of that is the emergency fund you're not supposed to spend. $192,700 of net worth and maybe $9,000 of genuine freedom of movement. So this rung has a split personality. On paper, you are the middle of America. In your checking account, you are one bad week from a credit card. And this is exactly where the trap sits. Income is up, $78,000, maybe $85,000. The house is worth more than you paid for it. Everything is objectively better. And the natural next move, the one most households make right here, is to convert that progress into a bigger house and a newer car and a payment that feels reasonable. Because the raise was real and the equity is real. The payment is real too. It just doesn't feel like the others because it arrived with good news attached. Second rule, every rung below the median is bought with income. Every rung above it is bought with time. Below here, you climb by earning more and owing less. Active, visible, satisfying work. Above here, you climb by leaving things alone long enough to compound. Those are different skills, and the second one is mostly the discipline of not touching something for years while nothing appears to happen. The households that stall at the median are not the ones who earn less, they're the ones who spend the raise. And the ones who get past it do one specific, deeply unglamorous thing. $247,200. Median household, 45 to 54. The unglamorous thing is this: when the income went up, the spending didn't. That's it. That's the entire move. A promotion takes you from $78,000 to $92,000, and instead of shopping for a bigger place, the whole $14,000 difference goes into the 401k the same week the raise lands. Money that never touches your checking account, never gets a chance to become a lifestyle, never has to be given up later because it was never had. From the outside, nothing about your life changed. Same house, same 7-year-old car, same groceries, same weekends. From the inside, you just pulled your entire timeline forward by about 4 years, and not one person watching you could tell. $14,000 a year for 15 years at a 7% average return is about $351,000. That's the raise you didn't spend. By itself, without a single other contribution, it is larger than the median net worth of every age bracket in America under 55. This is also the rung where a specific kind of fear shows up. You run the projection, not a rough one, the real one, in a spreadsheet at midnight, all the way out to 65. And the number at the end is fine. Genuinely fine. It's just meaningfully smaller than you'd assumed it would be, and once you've seen it, you can't unsee it. That night is the single most valuable thing that happens on this rung. It either changes something or it doesn't.
The households on the next rung are the ones where it changed something within the week, while the number was still uncomfortable. Because there's a point coming where the spreadsheet stops being the thing that decides your outcome, and it arrives sooner than the projection suggests. $364,500. Median household 55 to 64. Peak earning age in America, and the highest median of any working bracket. Here, the math starts working almost without you. $364,000 at a 7% average return grows about $25,000 in a year. Your own contributions might be $12,000. The account is adding roughly twice what you put in every year, and that gap only widens from here. What you feel at this rung isn't excitement. It's the absence of a low hum you had stopped noticing was there. A dishwasher dies, you pay for it, and by Thursday, you've forgotten. A kid needs $1,800, and the answer is yes, and the answer costs you nothing except the money. That's the actual product, not the balance. The disappearance of the thing that was running underneath every decision for 20 years. But $364,000 is also where a hard number lands. At a 4% withdrawal rate, that's about $14,580 a year. The average retired worker's Social Security benefit is $2,071 a month as of January. Call it $24,852 a year. Put together, that's a comfortable, careful retirement. It is not freedom. The distance to freedom is measurable, and it's smaller than it sounds. $293,840 separates this rung from the next one. At a 7% return, an untouched $364,000 covers that distance on its own in about 9 years. You don't have to earn your way to the next rung. You have to not interrupt it. The next rung is where that word starts being accurate. Only about one household in 4 ever stands on it. $658,340. The top 25% of American households. 4% of that is about $26,000 a year, indefinitely, without touching the principal. Add Social Security and your money now covers a life. Not a lavish one, a real one, with the mortgage paid and the lights on. And the jump from here is where the numbers get strange in your favor. $658,000 at 7%, untouched, passes $1 million in about 6 years and $2 million in about 16, with nothing added. Every rung below the median took a decade of effort. This one takes a decade of leaving it alone. And your relationship to your job changes well before your job does. You start evaluating work differently because you could absorb losing it. Not comfortably, but you could. That is a very different person sitting in a performance review, and people notice, and it tends to be good for your career in a way that is difficult to explain to anyone below this rung. Third rule, past the 75th percentile, your money's job changes from growing to not being needed. Below here, the question is, how fast can this get bigger? Above here, it's, how little of this do I ever have to touch?
Those produce completely different decisions, and the second is much harder to sit with because from the outside, it looks like doing nothing at all. This is also where you start saying no. To the trip that would mean liquidating something, to a friend's business idea that doesn't survive 10 minutes of arithmetic. You feel the friction in the room and you say no anyway, and something in a few of those relationships shifts a couple of degrees and never quite shifts back. Everything from here up is a smaller and smaller slice of the country. And the last three rungs get bought with something other than income. $1,920,758. Top 10%. The millionaire rung, and it arrives with less ceremony than anybody expects. An app updates on a Tuesday. You look at it for a second. You go back to what you were doing.
4% of this is about $76,800 a year, permanently, without working. That is more than the median American household earns, generated by something you already own. And what actually happened to get here is almost boring. No windfall, no brilliant call. A household that reached rung 6 and then didn't touch anything for 15 years. Compounding did the rest. And compounding does its most spectacular work at the very end. The final doubling adds more dollars than the first several combined, which is exactly why quitting in year 8 feels so reasonable and costs so much. Fourth rule. The top rungs aren't bought with money. They're bought with what you were willing to not do with it. And one rung up, the thing you're buying stops being money at all. $3,779,600. Top 5%. At this rung, money stops being a source of anxiety and becomes a material. The question is no longer whether you can afford something, it's where the capital should sit and what it's doing while it sits there. 4% is roughly $151,000 a year. You did not work for it this year or last year. It arrives whether you are well or traveling or asleep. And the thing that's genuinely different up here isn't the spending, it's time. 3 weeks away and 5 of those days without checking anything at all. That's the purchase, not the trip, the 5 days. There's one rung left. It's the one everybody pictures when they think about this ladder, and it's the one almost nobody on it actually climbed. $13,666,778. 1% of American households are at or above this line. 4% of it is about $546,000 a year, forever, from capital alone. At this rung, the numbers stop describing a lifestyle and start describing reach. Structures that outlive you, decisions executed by people you trust, inside rules you wrote a decade ago. You could step away for 6 months and nothing would stop. And it's worth saying plainly, most people standing here did not climb these 11 rungs. Inheritance, a business that sold, equity that hit at the right moment. This rung is real and it's measured, but it is mostly not the top of the staircase everybody else is on. Which is why the rung that actually matters isn't this one. Go back to the two numbers we started with. 1,060,000, the average. 192,700, the median. You have spent your entire adult life being quietly measured against the first one while living somewhere near the second. The climb from rung 1 to rung 5, from 0 to the American middle, is the hardest stretch on this whole ladder and the one that changes daily life the most. Every rung above it is the same 2 moves on repeat. Don't spend the raise, don't touch the balance. That's the mechanism. It's available to almost everybody, and almost nobody runs it long enough for it to finish. Nobody is coming to tell you which rung you're standing on. There's no letter, no alert, no statement that arrives saying, you are here. You have to work it out yourself, and most people never do. So work it out. Everything you own minus everything you owe. One number, 10 minutes, and you'll know something about your life that you didn't know this morning. Then put the rung in the comments. Just the rung, not the number. Nobody needs your balance. I genuinely like to know where this channel stands because I don't think it's anywhere near where you all assume. And if you want the next one, we take one financial situation apart with the real numbers every week.